Ever feel like your business finances are a tangled web, and you're just snipping blindly hoping you don't cut the wrong thread? You're not alone. Many small business owners and entrepreneurs find themselves scratching their heads when it comes to truly understanding their financial health. You might be tracking income and expenses, sending invoices and paying bills, but do you really know if your business is making money? Think about it. You pour your heart and soul into your business. You put in long hours, make sacrifices, and constantly strive to grow. Wouldn't it be incredibly valuable to have a clear, concise snapshot of your profitability? A report that tells you in black and white whether your efforts are translating into actual profit. That's where the profit and loss P&L report, also known as an income statement, comes in. It's not just another financial document. It's a vital tool that provides a clear picture of your company's financial performance over a specific period. Think of it as a scorecard for your business, showing you the revenues you've generated and the expenses you've incurred to achieve those revenues. Why is this report so crucial? Well, for starters, it helps you understand your net income, the ultimate bottom line. Is your business profitable? By how much? Where are your biggest expenses? Are your revenue streams healthy? The P&L answers these fundamental questions, empowering you to make informed decisions. Imagine trying to navigate your business without a P&L. It would be like driving without a dashboard. You wouldn't know your speed, your fuel level, or if your engine is overheating. Similarly, without a P&L, you're operating in the dark, making it difficult to identify areas for improvement, control costs, or even secure funding. Lenders and investors rely heavily on the P&L to assess the financial viability of your business. They want to see a track record of profitability and understand your revenue and expense trends. A well-prepared P&L can significantly increase your chances of obtaining loans or attracting investment. Furthermore, the P&L is essential for tax purposes. It provides the necessary information to accurately file your business taxes and ensure compliance with regulations. Now, you might be thinking, this all sounds great, but how do I actually get my hands on this magical report? If you're using QuickBooks, you're in luck. QuickBooks is a powerful accounting software that makes generating a P&L report incredibly straightforward. In this video, we're going to walk you through the step-by-step process of running a profit and loss report in QuickBooks, unlocking this crucial insight into your business's financial health. Whether you're a seasoned QuickBooks user or just starting out, we'll cover everything you need to know to generate, understand, and even customize this essential report. So, let's dive into QuickBooks and see how easy it is to get a clear view of your bottom line. First, make sure you're logged into your QuickBooks account. Once you're in, navigate to the Reports section. You can usually find this on the left-hand sidebar. Click on Reports, and you'll see a variety of financial reports available. In the search bar at the top of the Reports Center, type Profit and Loss. You'll see a few options appear. The most common and generally the one you'll need is simply titled Profit and Loss. Click on this report. Voila! QuickBooks will generate a basic profit and loss report for you. By default, it usually shows the current month's performance. However, the power of this report lies in its flexibility. You can customize it to view different time periods. At the top of the report, you'll see a date range drop-down menu. Click on it, and you'll find a variety of preset options like this month, this quarter, this fiscal year, last month, last year, and many more. Select the specific period you want to analyze. For example, if you want to see your performance for the entire last year, select Last Fiscal Year. You can also choose a custom date range by selecting Custom and entering the start and end dates you desire. Once you've selected your desired date range, click the Run Report button. Now, let's take a closer look at the anatomy of the profit and loss report. It's typically divided into three main sections: revenue, cost of goods sold (COGS), and expenses. Revenue, also known as sales, represents the total income your business has generated from its primary operations during the specified period. This could include sales of products, services rendered, or any other income-generating activities. Next, you might see cost of goods sold (COGS). This section includes the direct costs associated with producing the goods or services you sell. For example, if you run a bakery, COGS would include the cost of ingredients like flour, sugar, and eggs. For a service-based business, COGS might include the direct labor costs associated with delivering the service. Subtracting COGS from your revenue gives you your gross profit. This represents the profit your business makes before considering operating expenses. Finally, we have expenses. This section lists all the other costs your business has incurred during the period that are not directly related to the production of goods or services. Common examples include rent, utilities, salaries that are not directly tied to COGS, marketing and advertising costs, administrative expenses, and depreciation. Below the expenses section, you'll find the net income or net loss. This is the bottom line, the ultimate measure of your profitability for the chosen period. It's calculated by subtracting your total expenses, including COGS, from your total revenue. A positive net income means your business is profitable, while a negative net income indicates a loss. But the standard profit and loss report is just the starting point. QuickBooks offers several customization options to help you gain even deeper insights. One useful customization is changing the accounting method. You can choose between accrual and cash basis. Accrual accounting recognizes revenue when it's earned and expenses when they're incurred, regardless of when the cash actually changes hands. Cash accounting, on the other hand, recognizes revenue and expenses only when cash is received or paid one out. Most businesses, especially as they grow, use the accrual method for a more accurate picture of their financial performance. You can usually find the option to change the accounting method at the top of the report customization settings. With that said, thanks for watching, and until next time.